Cryptocurrency has gone far since it first caught the world's attention in 2009. The crypto trading market has never been more a hype, with new and aggressive players setting their respective all-time high prices. But what really moves crypto? How does it differ from the traditional asset classes? And what steps should you take to successfully trade this market? All these questions and more will be answered in the following series of videos. But first, let's familiarize ourselves with a key definition. Cryptocurrency is a digital asset decentralized to a distributed network and exchanged in a peer-to-peer digital cash system. An anonymous programmer with the pseudonym Satoshi Nakamoto created the concept in 2008. He called it Bitcoin. From almost $0 in 2009 to more than $50K in 2021, Bitcoin's price has increased relatively steadily over the recent years. Bitcoin is the largest cryptocurrency by market capitalization at over $900 billion. But Bitcoin had also lost ground to other tokens, with only a 40% share of the total crypto market cap of $2.3 trillion. The crypto sector outstripped the performance of most traditional assets in 2021. Its numbers bear watching. Join us for Lesson 2, where we will look at the blockchain technology and decentralization. Rapid growth and experimentation are going on in the world of crypto today. Blockchain technology is just starting to revolutionize our lives. Blockchain is a system for recording and storing digital information on a network of computers in a secure, permanent, and decentralized way. Decentralization is key in blockchain. Take financial transactions, for example. A primary difference between the traditional system and Bitcoin is how transaction records are kept. In the traditional system, your bank has exclusive access and control over its ledger. Financial institutions stand between us and the trusted third parties with whom we wish to transact. What Bitcoin has achieved through blockchain technology is a way to establish the same consensus of trust without these central institutions. Bank ledgers are private and centralized. In Bitcoin, the transaction records are accessible to everyone participating in the Bitcoin network. Blockchain technology makes it possible for ledgers to be public and distributed, thus making trusted third parties unnecessary. Find out about the major cryptocurrencies in the following video. There's always action in the cryptocurrency market. Crypto's youth, its volatility, and the potential for high returns over the long term are features that draw investors of various stripes into this market. Here are some of the best performing cryptos and their market caps at the end of 2021. Bitcoin, $900 billion. Ethereum, $450 billion. Tether, $80 billion. Solana, $55 billion. And here are some fun facts. In 2010, a man paid 10,000 Bitcoins for 2 pizzas as the first Bitcoin transaction. 10 years later, this would be worth around $500 million. Ethereum co-founder Vitalik Buterin launched his platform with the help of a $18 million crowdfunding campaign in 2014. Unlike other cryptocurrencies known for their volatility, Tether is designed to be pegged to the US dollar, selling consistently at around $1. Solana is, as of 2021, the fastest cryptocurrency with a processing speed of 50,000 transactions per second. Watch our next lesson to learn more about other types of cryptocurrencies. There are 2 main categories of cryptocurrency: coins and tokens. The coin category includes Bitcoins, altcoins, and stablecoins. The token category includes fungible tokens, security and utility, and non-fungible tokens, NFT. What are Bitcoins, altcoins, and stablecoins? Bitcoin is the original blockchain-based digital currency, the first crypto. Other currencies coming after Bitcoin are known as altcoins. Altcoins are designed to improve on Bitcoin, with specific features or functions that Bitcoin does not have. For example, the Ethereum system has additional applications, such as the execution of smart contracts. Amongst the most famous altcoins are Ethereum, Solana, Cardano, Dogecoin, and thousands of others. Stablecoins are cryptos pegged to fiat currencies like the US dollar. Their name derives from the stability provided by their affiliation with a fiat currency. An example of a stablecoin is Tether, which is valued at 1 coin to 1 US dollar. What are tokens? Fungible tokens represent a standard value and have specific uses. Utility tokens, built on distributed ledger or blockchain platforms, are used to access or purchase products or services. Security tokens are traded like securities and usually issued through initial coin offerings, ICOs, like IPOs for stocks. Non-fungible tokens, NFTs, are unique collectibles representing ownership of rare items. More on NFTs next. Another type of crypto token is the non-fungible token, NFT. It is an asset that cannot be traded or exchanged like cryptocurrency. Cryptocurrencies are fungible. The tokens are identical and interchangeable, therefore can be used for commercial purposes. NFTs are unique and unreplicable. They are similar to digital passports in their non-transferability, but they can also be combined with another NFT to create a new unreplicable NFT. Some NFTs are designed to represent real-world value items, such as real estate or works of art. Other NFTs may represent persons' identities, property rights, or other non-tangible assets. NFTs are particularly popular among collectors of sports cards or vintage comic books, digital artwork, and other unique or rare items. But more than their usefulness to lovers of novelties, NFTs represent another step in the evolution of blockchains and cryptocurrencies. By digitizing ownership of physical assets within a tamper-resistant system, NFTs are pointing the way to exciting changes in the trading infrastructure of present-day financial systems. Like traditional markets, cryptocurrency markets are also affected by supply and demand. However, being decentralized, they are theoretically independent of the political and economic factors that impact traditional currencies. These are the factors that significantly affect cryptocurrencies' prices: the supply of coins in circulation and the frequency of coins' release, loss, or destruction, developments in the total market capitalization of cryptocurrencies and users' perception of these developments, the extent and quality of media coverage of a cryptocurrency, the extent to which a cryptocurrency merges with existing commercial frameworks, like electronic payment systems, and key events affecting the crypto space, such as economic setbacks or security breaches. Much of the volatility of cryptocurrencies is due to the market's youth, and most of the currencies' relatively small market caps. This makes them vulnerable to the actions or pronouncements of individual players. But with increasing big business investments and clearer government policies on crypto, the market could mature and become more stable and predictable. Still, of course, nothing is written in stone. That is the way of the market too. 3 essential terms to know in cryptocurrency trading are spread, lot, and leverage. Spread refers to the difference between buy and sell rates. As in traditional financial markets, you have 2 prices to choose from when you take a position in cryptocurrency trading: the buy rate and the sell rate. Lots tend to be small since cryptocurrencies are highly volatile. Most are just 1 unit of the base cryptocurrency. Yet, some cryptocurrencies are traded in bigger lots. Leverage is a way of trading significant amounts of cryptocurrency by paying a margin instead of the total value of what you purchase. While leverage can multiply the gains when the trade is going your way, it can also multiply your losses when the trade suddenly turns against you. For this reason, it's important to use leverage wisely and in conjunction with sound money management rules. Up next, a description of the main crypto trading tools. Successful crypto trading does not happen through sheer luck or by chance. Successful traders rely on effective crypto trading methods using a broad range of trading tools. Let us take a look at some of them. a crypto calculator that frees you from tedious, error-prone calculations. Different types of calculators perform different tasks. For example, currency converters and profit-loss calculators. A crypto trading chart provides investors with visual market data to identify trends and various trading indicators, enabling traders to make informed decisions. A portfolio tracker gives you a quick reference of your total investments, daily changes in your portfolio value, and the individual performance of each coin in your portfolio. Other tools are available in the market. Choose one that suits your needs. Up next is a video on diversification and timing. Never put all your eggs in one basket. This is oft-repeated business advice, which holds true for cryptocurrency investments. Cryptocurrency can undoubtedly be a profitable investment, but the crypto market is highly volatile and unpredictable. These factors make diversification a wise strategy. Diversification requires you to invest in 2 or more currencies, depending on how investment savvy you are. It allows you to enjoy significant gains from high-performing currencies, effectively cushioning losses from poorly performing ones. Crypto diversification is not just about investing your money in several currencies. It could also mean timing your crypto purchase. Keep updated on price movements so you can buy or sell your cryptos at the right time. Do not buy your cryptos in one go. Instead, allocate specific amounts to invest at specific times. When prices go down, add new cryptocurrencies to your portfolio. When things are looking up, either you keep them or sell them for a profit. Because of the crypto's volatility, always research prices, trends, and currency potential. The next video is about crypto trading psychology and risk management. Trading psychology is the mix of a trader's mental and emotional state that can spell the outcome of trading cryptos. The fear of losing and the greed for more gains are behaviors linked to crypto trading psychology. Crypto traders must develop a trader's mindset that starts with developing a trading routine and allocate a lot of time for learning trading skills to improve your success rate. Limit your risk exposure by setting up your stop loss. Step back to evaluate how to do better on your next trade. Start small, then increase your investment in gradual increments. Be content with small gains and focus less on the losses. Place your trade and walk away. You can't control it anyway. View the next video to learn how to trade crypto. Trading in cryptocurrency is a diversification tool that lets you gain from the market's boom periods while preserving your assets' value despite economic uncertainties. Follow these steps if you want to trade crypto. First, study the cryptocurrency market thoroughly because cryptocurrencies behave differently from traditional currencies. Second, plan your trading strategy for your chosen cryptocurrency. Set your stop loss and take profit levels, and incorporate risk management tools to guard against volatility. And finally, conduct your trades on your chosen trading platform. Remember that trading platforms are different to one another. Choose one that suits your needs. For example, with a simpler or more advanced user interface. Here is an example of a successful crypto trade. You buy Ether because analysis tells you it will undergo an upgrade. When that upgrade happens, Ether's value may rise, and you will have gained from your timely purchase. Analysis leads you to speculate that the price of Ethereum will fall, so you sell it against the US dollar. If your speculation is correct, and Ethereum's price does fall, you will have gained from your timely sale. In the next video, the summary of the course. Congratulations! You have made it to the end of our crypto trading course. You should now have a solid understanding of all the fundamental aspects of crypto trading. We recommend that you go over the course a few times, just to strengthen your knowledge. Here is a summary of the course. Successful crypto traders have certain qualities in common. Look at this checklist of traits and see if you have a crypto trader's mindset. Study and keep updated on the crypto market and events that impact it. Plan crypto trades based on research, analysis, and risk assessment. Keep crypto investments diverse. Crypto trading is new, exciting, and potentially rewarding, yet risky. With crypto's volatility, you can win big or lose big. Knowing how to manage the risks is key to participating successfully in the crypto market. So, keep studying the market and refining your methods as you trade. Your trader's mindset will keep you from getting reckless when you win or desperate when you lose. Remember to step back when necessary, keep your balance, and regenerate yourself for the next trading day.